Hi everybody, Jeff Yasteen here. Hope you're staying safe with the coronavirus situation. You know, it's funny, actually sad I guess, how Wall Street analysts love a stock when it's overvalued and highly priced, and they hate the same stock when it finally sinks to a lower and more value-laden price. But that's where we find ourselves with Beyond Meat these days. Just to catch you up, last August with the stock at 174, I said to avoid the shares. Great growth prospects, but terribly overvalued at that level. By November last year, the price fell to $79, down 54%. Still too overvalued, I said. Wait till it drops almost by half again to 45. Well, last week it hit 50. And to me, that's close enough. This one's cooked all the way through, ready to serve, ready to buy. Now, over half of Beyond Meat sales come from the food service industry. And Goldman Sachs thinking the virus represents a major threat to sales since most restaurants are either shut down or limited to takeout items. According to the firm, when things get back to normal, they believe that perhaps many restaurant chains will be more interested in survival rather than serving up the latest valuable food items on their menus, and therefore will be less interested in plant-based menu products. And lastly, according to Goldman Sachs, with the virus having prompted cross-border trade restrictions in Europe and other places, Beyond Meat's international growth prospects might be off the menu as well for some period of time. Now, obviously, I see this differently. The impact of the virus and its associated economic fallout is transitory, and whether there are vaccines in a month, 3 months, 6 months from now, the fact is that no one's really going to care about the COVID-19 virus a year and 2 years from now. All of that is basically water under the bridge, and it's had its impact on the economy and the stock market and is in the process of being discounted. More importantly, at a recent $65 stock price, down 70% in 8 months, those concerns are already well reflected in the price of Beyond Meat shares. Now, granted, the stock remains overvalued by traditional measures. Analysts expect 2020 to be the company's first year of profitable operations, and they expect it to generate profits of around 25 cents a share. If we divide the price of the stock by this year's profits, projected profits, we get a price earnings ratio of 260. Now, then again, all things being equal, how much would you pay to own shares in a company that, despite the headwinds of COVID-19, is still set to nearly triple its profits in 2021 to 68 cents a share, and then nearly double those profits again to $1.20 a share by 2022. So if we multiply the 2021 profits by the current PE ratio, we get a stock price for Beyond Meat of about $176 a share by late next year. And if the company hits its 2022 earnings targets, and let's say it gets an even more depressed multiple of say 100 times earnings, we still are talking about a stock that will be double the current price. So that's the whole point of owning growth stocks, especially high growth stocks. If a company's earnings are rising by 50%, 100% a year or more, it's easy enough to justify a high PE ratio because the company is going to grow into that ratio very quickly. And that's also why it's important to buy shares of companies like Beyond Meat when they're down, when Wall Street analysts turn negative on them, and when much of the risk of owning them is already well priced into the stock. I'm Jeff Yasteen, wishing you the best of good buys, and make sure to keep following me on social media and subscribe to my YouTube channel.